Yeah, unfortunately, May's been a pretty tough one. We're down about 2% for the month to date, which is not a great place to be. There's been a lot going on in our market. We've had lots of macro events, we've had lots of results, lots of confessions. So there's been plenty for the market to digest, both locally and offshore, and that's made for a pretty whippy month. But I think as the dust settles and as we progress through the rest of the month, things will probably start to pick up. We're seeing some of that positive momentum now with some of our bigger companies report results, and that's probably just settling a few of the concerns of investors, but still quite a hard grind so far this month. Yeah, so the big macro event that everyone was waiting for was the Reserve Bank decision around the official cash rate, and no real surprise, they kept it on hold at 5.5%, as it's been for about a year now. However, there were a couple of big surprises in the detail, I suppose. One of those was that the Reserve Bank has raised its peak OCR forecast very slightly. The big one was probably that they had some discussions about potentially raising the official cash rate from these levels. Ultimately, it was a consensus decision from the whole committee that they would keep rates at 5.5% on hold, but certainly that's worried a few market participants that there is these conversations happening around potentially raising rates even from here. I think it's a little bit strange for the Reserve Bank to be taking that tone and even, entertaining the idea of raises, particularly when you think about their own forecast for where inflation is going to go. And by the end of the year, they're expecting it to be in their target band of 1 to 3%. So if inflation is expected to behave itself, I just wonder if it's more jawboning around, the risk of a hike, just to make sure that people are, staying conservative and not spending too much to get inflation down. The official forecasts are for an OCR cut to not come until May of 2025. That's still 12 months away, but I wouldn't take that as gospel. There's a lot of water to go under the bridge over the next 12 months, and things could change a lot depending on data. But as it stands, that's the official forecast, is that we're going to stay at rates at these levels for another year, which I find a little bit hard to believe. One key thing I think we're going to be watching for is the 30th of this month, which is when the government's budget is released. And I'm sure the Reserve Bank is watching it as well, because that genuinely has the potential to impact where policy goes. If the government comes out with lots of tax cuts and is expansionary in its budget, then we could see inflation stay stubborn or even rise a little bit from that extra spending that goes on from the government. On the other hand, if they're a little bit tighter with the government purse, then it could control inflation, bring it down more quickly, which opens up the potential for interest rates to get cut a little bit earlier as well. So very much a watch this space for what happens with the budget, and I think that will be, a key driver of market sentiment around where interest rate policy will go over the next 12 months. Yeah, so saying that, results have been mixed would probably be a little bit kind. Of the companies that have reported so far, very few have seen share prices go up after their results. And it's not to say all these results have been really bad. It's just that, even half decent results, given the negative sort of sentiment out there and the caution from investors, are seeing share prices come down. And then anyone that's disappointing the market is seeing their share prices really get walloped. And on that note, a couple of the worst ones that we've had haven't actually been result announcements. They've just been sort of more confessions, stuff we've seen in the last few weeks as well. And the big ones came from Comvita and Michael Hill. So Comvita have reduced their earnings guidance by 20%, largely because of weakness happening in China at the moment. They've withdrawn their forecast for 2025. They had an aspirational target earnings number. They've pulled that from the market, and they're in a funny little position at the moment where earnings are clearly being impacted, but they are under a takeover offer. We don't know who it's from, but there is some interest in a potential suitor for Comvita, and that's keeping the share price probably a little bit more sticky than we'd expect when you've got these downgrades coming through. So a funny little trading environment for them at the moment. The other, I guess, and I'd call it a disaster probably, has been from Michael Hill. It's really going from bad to worse for the jewellery retailer at the moment. And after an okay first half, they announced that in February, trading has really deteriorated, and they've made a loss in that period since February, and that's expected, I think, to continue through the remainder of their financial year, and things could get pretty ugly there, and you could see their performance for this year down about 80% on where earnings were last year. So a tough environment for anyone in that retail space, and Michael Hill seems to be at the epicenter of it at the moment. Yeah, always nice to finish on a positive, isn't it? So I talked about some of those poor results or announcements, but there's still been some very good ones as well from some of our quality companies. So 3 or 4 that have really stood out for me. Turner's Automotive, they had a record profit before tax number of 49 million, helped by the auto retail division, which is just the part of their business that sells cars, which is probably what we're most familiar with. It continues to defy gravity to some extent. A little bit of help, partly from the cyclone impacts and people changing cars and needing to update their cars as a result of that last year. But I think it really reflects a sensible strategy and a good management team there. So, another great result for that business. Napier Port, the other one. The first half was very good, earnings up 25%. Again, albeit last year was tough because of cyclone impacts, so they are working off some easy comparable periods. But again, a good result from them. The market liked it. The share price was up over 6% on the day of the result, so tracking nicely, and a good chance that they hit the higher part of their full year guidance as the year plays out. Gentrack was the other one. Recently came into the NZX 50 index, so it's more at that small cap end, but another strong first half from them. They've lifted their full year guidance. They've got a mix of new customer wins, but also existing customers wanting to do more business with them. So things going from strength to strength for that company. And I think on a share price basis, it's one of our best performers both last year and so far this year. And then finally, one of our big names, Infratool, steady as she goes, really, hit their guidance for their full year numbers. No real surprises there. The one surprise was probably the amount of capital expenditure they expect to cut a check for, basically, for growth initiatives. And while it's you have to spend more money as a business, the flip side of that is it's for positive reasons. There's lots of growth opportunities, particularly in their data centers and their renewable energy space. So the market will like the growth potential that they've got without having to go and buy other businesses. Just organically within their own company, they've got lots of that growth opportunity, albeit it comes at the requirement of more cash to be put into it. But another good result in what has been a bit of a minefield of reporting season so far, with some real disasters as well.
For more insights, visit craigsip.com.